Hello, everyone. Happy Wednesday? It's Wednesday, right?
I don't know.
Beautiful midday in Singapore. It's pretty hot out, but I am on stage with some of the biggest names in crypto, so I'm super excited to sit down with you guys. And stablecoins, topic of the day. I feel like stablecoins is the topic of every single conference that I go to right now. And I would argue that 99.9% of people in this audience have stablecoins. They use them, they love them, and there's definitely a product market fit. But what about outside of the industry? I think that is probably the topic of discussion that I want to lay the land with all of you. How do you kind of think about adoption from a mainstream perspective beyond where we are within this industry? Because I would argue most of these people have stablecoins and use them every day, but how do you think about getting it to the hands of the average person? Paolo, go first. I'm looking at you.
I will go first. Hello, everyone. I think that the actual, talking from my point of view as Tether and USDT, what we are seeing is that 35% of USDT users, we have around 500 million users, 500 million users across the emerging market developing countries, and about 35% of them are in fact using USDT as a saving account. On top of that, 70%, between 60 and 70% of the transactions that move USDT alone. That tells us that a lot of people that are using USDT are using it as their currency, as their mean of payment, as their savings account. So I think the beauty of what we are seeing with USDT is that it kind of started to decouple from the specific usage as a crypto rail. Of course, that is still important, but at the same time, it is reaching the broader utility for all the people that don't have access to dollars in the emerging markets. Think about people in Turkey, in Argentina, in Vietnam, in all the people that are underserved, underbanked, that they have been left behind by the traditional financial system. That people not necessarily are in crypto. They don't necessarily are interested into buying some volatile tokens. They look forward to have stability in their lives. They were used to buy cash dollars in the black market, in the streets, and now they just found a better way through stable coins to hold dollars, to hold a stable value. Stability is, again, relative, so they hold a stable value compared to their local currency. Of course, the ultimate inflation hedge, we all know that is Bitcoin.
Mm-hmm. How do you think about the broader mainstream adoption, Charles?
So I think probably it was about a year, maybe a year and a half ago, where you hit an inflection point where stablecoins started to be used outside of crypto. Mm-hmm. And so I think that was and it started to build, and then you had the Genius Act pass, when you had the administration change, which changed their view on stablecoins in terms of embracing it, and then of course the Genius Act. And that has just led to a complete change in the wind being in your face to the wind being from behind. And now with the Genius Act passing, you didn't need the Genius Act pass to have stablecoins, obviously. We've been issuing stablecoins for years and years and years. But you probably remember this, like 8 years ago, issuing stablecoins, everyone's like, well, what's the business model? That doesn't make any sense. It's not that interesting. Of course, interest rates changed and the world changed, and you can now see how stablecoin is providing both a better rail, which is kind of obvious, 24/7, instantaneous, programmable, completely transparent, virtually free. That's amazing, but it's also an account, as Paolo was saying. And that wasn't all that obvious too long ago. Now that Genius has passed, and it's made a clear legal framework for how you would issue, at least in the US, but really setting standards probably for the whole world. Every institution in the world that is moving dollars, especially when you're moving them cross-border, you're moving them for businesses, you're moving them in complex ways, they're trying to think, how can they use stablecoins? And there's an enormous stock of dollars that are moving inefficiently. And it's the reserve currency, but it's also the most inefficient currency and the most expensive currency to move around. So that's part of the reason why I think everyone wants to talk about stablecoins now, is because you had this fundamental change in the operating environment. And it's not just being driven by the crypto price anymore. It's being really driven by adoption curves from large institutions, small institutions, new fintechs starting up and being able to offer products in a way that just was never possible before. It's really kind of a golden age for stablecoins here.
Mm-hmm. And then Rob, for you.
I want to double click on this a little bit, because Paolo talked a lot about like the demand for US dollars in emerging markets, right? And I think that's been a lot of the Tether story. And we've seen a lot of that, especially across Asia, across Latin America, Africa. But we did a report with a business called Artemis, which does a lot of stablecoin data earlier this year. And by far and away, the fastest growing area of adoption and usage right now has actually been cross-border B2B. So this is very much a SMB story, not necessarily a large enterprise story right now. But we're looking at a $200 trillion market. It's about 8 times bigger than the retail cross-border market in remittance. And we've started to see those companies, those people who operate in those, call it like emerging markets, but maybe also, not just tier 1 markets, but tier 2 markets, who've understood that they're not well served by correspondent banks, right? And they want to be able to utilize a technology that has frictionless money movement, that treats them better, that serves them better than the banking system, which our legacy financial rails has served them. And so that's where we're seeing a lot of adoption across our portfolio, is this, call it middle market of businesses, along with the US dollar access, where as they accept stablecoins, as they use stablecoins, as they use things like grain cards to pay for expenses, like that has allowed for stablecoins to be just a linchpin of how they operate everything that they do, versus having to go call it from stablecoin to fiat and then back and forth and having to fiat be an everyday part of their life. And so as stablecoins are the end point and are the things that people hold, that means that now you don't have to have fiat and you can start using it everywhere else, and that will really proliferate, I think, the usage for both from businesses and from the retail users themselves.
When it comes to investing in different stablecoin startups, I'm sure you get hundreds of pitch decks on this front. What types of stablecoin or payment opportunities do you see hitting your desk that actually interest you?
Yeah, so we've definitely seen hundreds over the last year. I think I have Stripe to thank for that in many ways. What I tell people is you have to do the hard things, right? And so what has crypto made easy, or what have blockchains made easy? They've made the money movement or the movement of value in information a lot easier than it was before, right? Like we had things like Swift and correspondent banks who did that. We don't need that messaging system anymore. Now what we need is people who do, call it the edge cases really well, who do last mile, who do compliance really well, who do or face off with the distribution directly to the end consumer really well. And so what I tell people is like, what is differentiated about your product? Because if it's an API of APIs, if it's just somewhat sort of middleware layer, like often like you're not really doing anything better than you could be doing for directly on a blockchain itself, or you could be doing through, or you don't really have value capture. You don't really have a moat in that case. And so do the hard things, think about the last mile, think about the end distribution. That's where we're seeing people, I think, win today as issuance becomes, no offense guys, a little bit more of a commodity these days.
I mean, Charles, Paolo, you both run very successful businesses. And before you were talking about the Genius Act being passed, which has really given like a tailwind to stablecoin adoption, right? So everything seems pretty optimistic, but what is keeping you guys up at night? What are you afraid of not really helping scale this sector?
So from my point of view, what we are trying to do at Tether is to capitalize on our position in emerging markets. Again, I keep talking about the emerging markets because definitely there is a lot of interest on stablecoins also coming from the United States, but we think that the real opportunity still sits with the emerging markets. There are around 3 billion potential users. Right now we have 500 million, so we can scale up much more. At the same time, I'd agree with you on the fact that what matters is distribution, right? So the technology behind stablecoins is not rocket science. Of course, you need to have, now with the Genius Act, you need to have licenses, you need to have compliance, robust compliance teams, but at the same time, the technology is very easy. So what matters is distribution. So, that is, I think, what we got right at Tether from the beginning. We started buying distribution channels, investing in distribution channels that goes from chains of shops in Central South America to kiosks in Africa and Asia. Those kiosks and those shops where you can buy a phone credit, and every week you go there, you buy something, and that huge distribution network. I think that Tether built the biggest physical and digital financial distribution network in the world, with boots on the ground, with hundreds and hundreds of thousands of these touch points that are unique to us, that allow us to keep scaling on even the smallest communities in Africa. And so that's what we are going to continue to do, because I think that we need, if we want to create this global monetary network that empowers the people, the poorer people living in emerging markets, and put them in contact with, let's say, the richer people living in the Western world, I think that's what we should be doing, right? Otherwise, stablecoins will remain just a niche for who has already a lot of access to finance. That would be United States and Europe.
Is there any distribution network that you've struggled to tap into?
I must say that we're doing a fine job covering all the bases. For example,
You're everywhere. Yeah.
It's not only physical. If you think about it, we are major shareholders of a social media platform called Rumble in the United States. They have 51 million active users in the United States. And soon we are going to, in partnership with Rumble, Rumble will launch the Rumble wallet that will be based on wallet development kit that is called WDK, that is Tether wallet technology that will be released later this year, will be fully open source. And the aim there is to prove how we can convert 51 million active users, mostly in the United States, to use stablecoins within the United States, so the most sophisticated country nation for financial rails, but at the same time empowering them to use stablecoins also to interact with the rest of the world for remittances, cross-border payments, commerce, and all that.
Charles, what about you? What's keeping you up at night at Paxos?
Well, I think the market is in such an interesting point because you are going to be in a position where you probably have more than 2, but less than 5 major stablecoins that are rails. And then you're going to have probably hundreds or even thousands of other stablecoins. And we already see this starting to happen where, almost every chain is going to want to have a stablecoin. You see different businesses want to have them. In some ways, it's like branded credit cards or rewards programs or loyalty programs. And they're going to have various levels of success, but it's going to create, in some sense, fragmentation at the same time that I think you're going to have a consolidation that happens. And you're going to have the need then for bridging technologies, orchestration technologies, but you're going to really also have a lot of importance placed on solving problems at the edges. Kind of what like Paolo was describing and Robert was describing. You need to find where the unmet need is for people. If you want to go down to your local grocery store and pay, the current payment system works totally fine. You don't need a stablecoin for that. Where do you have problems? It's moving money across borders. It's I want to be able to have dollars, but I couldn't before. It could be consumer, it could be business, it could be in certain FX transactions where you have lags. So there's actually quite a few places where you have enormous friction in the current system, and you don't need to have scale to be able to solve them. And then there are big problems within the current system that you need scale. And in order to get to scale, stablecoins have to get much bigger. And then you can solve problems in like maybe wholesale markets or trading markets outside of crypto with stablecoins. It's not quite there yet. So it's still, even though stablecoins are quite big at almost getting close to $300 billion, that's kind of tiny in the drop of the monetary bucket, where there's like, $100 billion probably growing 10% a year. And so anyways, I think there's a big opportunity here for obviously stablecoins to completely shift the entire financial system, but it really is going to require ecosystems to be built around solving these problems on the edges.
Mm-hmm. I was at another conference last week. I was at a dinner. I was sitting next to an executive of a well-known Japanese bank, and he essentially told me they've been working on a digital asset strategy for over a year, and essentially a lot of it comes back to stablecoins. And a lot of times in crypto, we talk about the tech and the payment rails and all these different things that make everything faster, more efficient, et cetera, which I'm sure you all know is a definite talking point, and I think it resonates with a lot of people. But with this person in specific, he was saying that our company doesn't really care about making the tech faster. What they care about is profits. And so how can we use stablecoins in a way that allows for profit-driven adoption? And when we think about this $1 trillion payment shift, you have to think about institutions. So if that's the way they're thinking about it, how do you guys kind of have those conversations with them and say, okay, yes, the tech matters, but here's how you could kind of operate in a very profit-driven way?
Well,
go ahead.
I mean, I think we did a fine job in at Tether on proving that improving the financial rails for billions of people or hundreds of millions of people can lead to very good profits. I think that if you design a technology profit first, you're going to fail. So what you want to do is to create something that is uncompetable, so that you become ubiquitous, and then that's how you win. The more your technology is adopted, surely you can find a way to monetize it. When Tether started in 2014, we didn't have a clue of how we were going to monetize it. Until 2022, interest rates were almost zero, so the revenue model was very different and difficult on stablecoins. Of course, now that stablecoins are bound to, for example, U.S. Treasuries, and the yield is still like above 3.5%, is a juicy profit for everyone. But if you design stablecoins thinking about maximizing the profit now, what happens when most of the profits will go away because maybe in 5-10 years inflation will go back to zero? I believe that inflation will not go to zero, but nevertheless, I mean, I like to design technology that can survive no matter what is the condition of the world. So I think that they should go back to the whiteboard and redesign their incentives model.
Mm-hmm. I agree, but that's a bank for you.
Well, I would actually invert the question a little bit, which is, it's not so much, the opportunity is really that other people's profit margins can be completely shifted by adopting stablecoins, and that's going to unlock value. I think there's a couple ways. One is you can start democratizing access to the risk-free rate. In some sense, stablecoins are about democratizing access to dollars. And by the way, that's really important because it's generally not available. Maybe 5% of the world can get access to dollars without stablecoins. Being able to democratize access to the risk-free rate actually changes the value accrual from the firms that are holding that until to the end user, ultimately. And being able, and that's banks and all these institutions that are holding the yield back. And I think you can now start to see a world where by taking that interest, making it available to people who couldn't have it, say merchants who are holding dollars, end users who might be holding dollars, you're going to have a completely different way to acquire customers. And I think we're starting to see this with like some of the actions that are happening in the payments industry. How can you change around payments so that the interest is now going to accrue to merchants and to end users in a way that means you don't have to pay for payments anymore? You could actually like be paid to accept payments. It could be a complete shift for merchants in many ways because of where interest rates are. And so that is actually a way of taking profits that are sitting somewhere else, giving that to the end user, and creating a user experience that your customers are going to like, and that will drive adoption. And adoption is ultimately then what will create a better flywheel for your business.
Mm-hmm. I think what's really interesting here is you two both have essentially completely different models, right? Like Tether doesn't really share yield whatsoever. You and your largest stablecoins often share the yield back to at least the business itself, right? And when I talk to businesses and when we think about like, what is it that gets the banks excited? What is it that gets the Fortune 500s excited? For them, it's almost never, hey, we want to cut costs. It's always we want to drive revenue, right? Like you always seem to get somebody who's a revenue driver. And for them, the conversation is often, okay, well, can we, own the economics of the money market fund or the yield, right, as Chad was talking about. And they wonder why, if there's all these deposits on their platform, why are they sharing that with a stablecoin issuer? Why shouldn't they own that? Because they own the end customer. They have the distribution. Seemingly, they have a better moat, right? And so there's a lot of conversation around that. And I think stablecoins, if you go kind of to the next level on the payment side, we've also started to see conversation around interchange, right? So banks essentially have this monopoly on interchange, and payments are more costly today than they need to be because of that, right? If you can replace the issuer bank, you can put in some sort of technology solution that's maybe stablecoin backed, maybe uses like a stablecoin card. I mentioned Rain earlier that does this for some of their own issuing. I think there's others. Like then you can take that interchange away from the banks as well, and you can share that with the end customer as well. So maybe maybe for the bank that you sat next to, they wouldn't like that story, but for the technology company or the e-commerce company, the people who are actually facing off directly with the end customer that have the distribution, they want to figure out ways to get rid of the intermediaries. And I think a lot of what is happening in payments on stablecoin rails is about getting rid of those intermediaries, the issuer banks, the correspondent banking system, whoever the end issuers are. If you get rid of them, you share more of that revenue, you allow for just like less friction in the system. Everybody is going to make more money, except for those who have built their whole businesses by just creating friction.
Are there any specific startups that you think are building that today?
I've mentioned Rain a couple times before the company of ours to be just to be transparent, but I think there are a lot of people that are trying. I think broadly that is what the whole stablecoin industry is doing, right? These guys are the pioneers of it. But everyone is trying to figure out a way to get rid of, and frankly, I think like the community banks are in a lot of trouble, right? I think the issuer banks, I think Chad disagrees with me on this because we talked about the community banks a little bit yesterday at a different event, but I think there's a lot of people in the correspondent banking system who just do not need to exist anymore. And if we can provide internet money for that is more borderless, that allows for more people to interact directly with the system, then we can get rid of a lot of these entrenched incumbents who aren't supposed to, who don't need to exist. And I think this is why you see, we talked a lot about Genius already. There's rulemaking that's happening right now in the passage of Genius. Genius doesn't actually go into full effect until early 27. And there's some lobbying in effect right now by the banking lobby in the US that is upset about the idea that issuers can share revenue with somebody who has distribution, like say a Coinbase does with Circle, and then they can pass it on to the end customer, right? And they're upset about that because they say this is yield sharing with the end customer. There's just an intermediary in there, and they're worried about deposit flight. And the reason they're worried about deposit flight is because they do not innovate. They do not want to compete on the economics. They want their regulatory moat that they've had that does not need to exist for any other reason than the fact that they've just been there and they think that they're beholden to it, right? And so in my mind, what we're doing now is we are creating innovation by pushing the boundaries, and it's not me, it's these guys that are doing that.
Mm-hmm. For both of you then, obviously Paxos and Tether, they both have stablecoins. There's many options out there for investors in the market today. How do you kind of think about the go-forward offerings for stablecoins in the US and then globally? Is it kind of a winner-takes-all mentality, or you think there's opportunity for a handful, like one of you mentioned before, for about like 5 of them to really prevail?
I certainly think there's going to be more than one. And I think there's probably going to be more than 2 even. I think it probably ends up like 3 to 5. Mm-hmm. And by the way, it's not that much different from the current payment system. I mean, you have Visa, MasterCard, of course, and there's Amex, and then there's Discover, and you kind of go down from there. I don't know if that's a perfect analogy. That's not exactly what this is. But I think it's probably fairly close. But at the same time, you end up having this real proliferation, and I was talking about that before. But I definitely agree with Rob that part of the whole point here is that the marginal cost of operating in the financial system should trend towards 0. Mm-hmm. That means the marginal cost of being able to create a stablecoin trends towards 0. The marginal cost of being able to offer financial products should tend towards 0. And so you have this giant unbundling that happens as a result of this financial innovation, and eventually that'll then lead to rebundling and some re-centralization in some way that we probably won't like, and there'll have to be a new wave of disruption. But that's kind of like the history of everything, and so I certainly think that will happen here, which is you're still going to have the traditional banking system intermediaries start to break apart and create more opportunities, just like it did in telecom, just like it did in media, just like it did in all other kinds of industries. It just took longer to happen in the financial industry, and it had to really come from a completely different angle. Just look at this conference, TOKEN2049. I mean, this is not like a bank conference by any stretch of the imagination. And that's what was required because the traditional financial system is so regulated and has created such incumbency that you needed to have something completely come from a different angle. And that opening up is just beginning. And so we're talking about it as if it's like, almost finished, whereas like we're probably in just, I don't know, to use an American analogy, we're just in the first inning here. And so I think there are big opportunities, and it's going to evolve in ways that we can't even truly understand right now, because you're talking about systems that are so big and they're also so old. I mean, they just don't operate well. I mean, days to move your money, but you can order toilet paper at your house in hours. Like, how does that make sense? It's basically the same technology that moves email is what moves money, but one is taking forever and one is instantaneous wherever you are in the world. These anachronisms are obvious to everybody now, and but yet the disruption hasn't truly happened yet. It's really just at the very, very earliest stages.
Paolo, what's your take?
So from my point of view, I'd like to distinguish different areas of the world. The United States, I would describe the United States financial rails as 90% efficient. So if you put a stablecoin in the United States, you need to find the reason of why people should use it, and so why they should embrace a new technology on top of something that is already very, very efficient. And making money programmable is or having T+1 settlements where 1 is 1 second, not 1 day is great. All that, right? So, and for that, in the United States, people are used to have bank accounts and are used to get an interest on their bank accounts. But I like to describe as everything as being relative. So if you are in Mozambique, in Nigeria, and other countries, the devaluation of their national currency is so fast compared to the US dollar that sharing the yield 3-4% per year doesn't matter much when maybe their national currency lost 50% or 60% year over year. In Turkey, the inflation last year in 2024 was 50% year over year. There are 120 million people, 110 million people in Turkey. So I think that there will be many stable coins which lots will focus on the local needs of every single country, and few will coordinate all this global liquidity, and the FX market can be on-chain, off-chain, and so on. But really thinking about one stable coin that can fit all the use cases, I think is going to be harder and harder, both because of regulations, and certain countries' regulations will make it almost impossible to operate at a global level and offer basically a product that fits the needs of 200 different countries. And so that's what we are thinking at Tether, how we can actually start designing stable coins that are fitting the local needs. USAT is a great example. I get a lot of questions why you have $2 stable coins. In the United States, I see the need of efficiency and the need of having a stable coin that speaks to the digital crowd, to the young population that does, to the vibe coders, for example, to the AI economy. But the AI economy is not the first focus of a community in a small village in Lagos, for example, right? So thinking about the same stable coin and the same incentives to run a stable coin should fit both use cases of an AI economy and a person in a very small village in Mozambique is, I think, not the right approach. So that's why we are thinking about studying all these different use cases. And on one side, on USDT, yes, it's true, we retain all the interest because, again, we serve 500 million people that they want to ensure that Tether is strong, is stable, and can maintain this product for the next 600 years without worrying to have to share every single basis point back to the user, because, again, what they make out of using USDT is already infinite compared to what they make holding their national currency. In the United States, of course, the incentive scheme is different, and so we are designing USAT to be speaking first to who is investing a lot in tech, in AI, and the improvement of already almost perfect financial rails.
The American opportunity front, I think it's very different than the emerging markets, as Paolo was talking about, with inflation going up to like 50%, 80%, whatever it may be. In America, yes, we have inflation. Things aren't like perfect, but the need for stablecoins isn't necessarily the same. So what do you see as the American opportunity? And we can start with Paolo, because obviously you just launched USAT, and then we could talk with you two as well, because you are based in America, I believe. And so obviously you have a perspective on that front too.
So I think that in the United States, our focus will be on very much digital avenues for the distribution of USAT, our domestic stablecoin. I mentioned before the idea of using our existing partners like Rumble with 51 million active users per month. One interesting point is that Rumble has the highest average salary as a user base in the United States. So these are people that would that are maybe more financially savvy. Between 2023 and 2024, Rumble creators sold more than $800 million worth of gold through the Rumble channel. So there is an entire economy around these type of social media platforms, and we believe that at Tether, if we create a wallet as a distribution channel for stablecoins and for proper products that can fit the use cases of the United States, right? So like, again, tokenized gold is a good example. I know that you guys have also a tokenized gold product. These are things that I think are very fitting for the United States. So a wallet that can become the payment mean, allow people to maintain control over their own wealth compared to having money in a bank. I was hearing people still, also in the United States, some crypto funders were debunked in the last administration. Thankfully, this administration is much more keen on crypto, but you will see maybe in the future more and more people being concerned about keeping the entire wealth in banks, and so keeping part of their wealth in stablecoins and other digital assets in the United States is going to be more and more important. And so having a way to offer them custody and a way to transact. Keep in mind that also in the United States there are a lot of expats coming from Mexico, El Salvador, Argentina. So these people are sending money back home, and the best way to send money back home is through stablecoins. So we are speaking to that crowd because we know that very well. So digital plus remittances that originate from the massive remittances corridor coming out from the United States.
So we actually issue stablecoins out of 3 jurisdictions. One is here in Singapore, the other is out of New York, the other is in Abu Dhabi. So we actually have a pretty broad issuance platform because we're trying to be neutral infrastructure. We're not trying to create one stablecoin that is going to try to rule them all. That's not the idea. I don't think that's what will work. You have different ones for different communities. We issue the PayPal dollar for PayPal as an example. We issue USDG on behalf of 80 different institutions. We in the past have issued the Binance dollar. So there's different companies, and there's different communities that have different needs. And what we have done is create a multi-jurisdictional compliance framework so that our stablecoins are able to operate in all types of different markets. So in the US, we're issuing it from New York. Here we're issuing through an MAS entity. We're doing something in Europe. We have a issuing entity in Europe as well, so we're MiCA compliant. And so unlike really, I think, any other stablecoin issuer, certainly as an infrastructure platform, anyone can come to us and you can now have a stablecoin that is able to operate in many different markets. You can operate in Europe, you can operate in the United States, you can operate globally, and so you can kind of choose your own adventure in a way. Do you want to be in the US market because you really want to make sure that you can solve problems that are related to, like Paolo was describing? Do you want to be able to operate in Europe? Do you want to be able to do different things in global markets or in the Asian markets? Nothing's the same. All these markets have nuance to them. And so our goal is really to work with end distributors. We're not trying to distribute these dollars ourselves, and distributors that are in these local markets and have that expertise and understand what the needs are of their customers.
I think you originally asked, like, what was the opportunity for US, right? And I think Paolo touched on one, which is remittance. And I think by some data, I think Artemis put out, they think something like 10% of the remittance from US to India is now in stablecoins, something similar to that, US to Mexico. These are 2 of the biggest remittance corridors in the world. So that's obviously very positive for the US opportunity. I think the question becomes is how does it go from remittance for emerging markets, it's still very much an emerging market story, even though it's originating from the US, to how do Americans want to interact with it every day? And I think there's 2 things that are happening. One is I know of probably a few dozen Fortune 500s right now who are doing RFPs essentially to try to put stablecoins as part of their treasury management solutions. Again, you're Coca-Cola, you get 80% of your water from Western Africa. You want to be able to pay your suppliers, but you don't actually want to park the money in Western Africa, and you also want to be able to continue to get yield. So a business like that, a multinational, who even if they're served by JP Morgan, is actually frankly like usually unhappy with JP Morgan if you talk to them, they can understand that they can take more control. And we're starting to see a lot of that. Some of these these names out there that are doing this are very, very large names, right? I think the next question is like, do we have to have fiat at the end, right? And the more that we can make stablecoins usable and it can move like the internet, then the less that we need fiat and the less that, or the more that people actually gain from being able to stay in stablecoins, because it is lower cost, because they don't have the same interchange, because they can actually get intraday yield or a programmable yield. That is, and I think Paolo also talked about the agentic economy. Nobody knows where that's going, but I think we're all, in some way believe that there is going to be an agentic economy. It's clear that the ability to move more freely outside of traditional banking rails is where people make money and where people get more excited. And so I do think there's a U.S. opportunity, even if it's not quite the same of the, U.S. dollar access focus that we're focused on in emerging markets.
Right. Taking a step back from just the U.S. specifically and more at a global perspective, do you see stablecoins replacing deposits then? And if so, by what time frame?
I think that they won't replace deposits in some sense. They'll replace it in the payment system. So the whole beauty of stablecoins is that they're fully reserved dollars. You don't have to have fractional dollars. And so when you hold a stablecoin dollar, that's the safest dollar in the world, depending on exactly how it's issued. But in our case, we're issuing it from a trust company. It's held in the customer name. It's not our liability. It's actually the customer's asset. They're holding the T-bill themselves. That's actually safer than any dollar you put in a bank, at least up to the insurance limit where the government is backing it. So you can hold huge amounts of dollars, and it ends up being safer. It's safer than a money market fund dollar, and certainly safer than a banking dollar. And you want to have that in your payment system so that when there's another financial crisis, and there will be, you don't have the accelerator effects that you got in the last one. So it's great. You separate the payment system from the banking system, but the banking system is still going to make loans. It's still going to have fractional dollars in it. It's still going to want to borrow money from people. A deposit is ultimately just a loan. You're loaning money to a bank. We call it something different, which is deposit, and it kind of obfuscates it because it's a special loan, but it's just a loan. And so you loan money to a bank. That bank is able to then turn it through the multiplier effect into many dollars, and that's the special thing about being a bank, and that's why it's highly regulated. And so you're not going to get rid of deposits, and you'll probably even come up with a way to put deposits, or let's call them loans to banks. You'll be able to come up with ways to maybe create them fungible, be able to move them around in a way that makes it quite efficient versus how it is today, where it's just held in that one institution. And so you can be able to transfer it around, but it'll probably be through stablecoins, would be my guess. So stablecoins will be that mechanism that allows it to move. And that's why I don't think that it's stablecoins versus deposits. It's stablecoins plus deposits. And frankly, banks have all of the end users today, and they have to do a good job of keeping those end users. And to the extent that the end user wants to be able to send money in a way that requires a stablecoin, they have to be able to offer it. And so I wouldn't look at that as competitive at all. I would look at that as actually complementary. And in some ways, and this is where Rob and I have disagreed in the past, but even for smaller banks, it actually is a big opportunity, because they rely on all the larger banks to move money up and through, whether it's cross-border or even in the U.S. you're trying to do interbank clearing. It all goes through big banks. The smaller banks now could actually unlock a lower cost curve and a way of helping their customers and giving their customers a much better experience than they get right now. So kind of one hand it takes away, and the other hand it gives you opportunity. And you just have to figure out, are you going to embrace it, or are you going to kind of sit there and complain about how you wish it was the old days?
I think it definitely eats into deposits, right? I mean, there's a reason the banking lobby is specifically telling the U.S. regulators they are worried about deposit flight, right? Like we have U.S.
But it doesn't eat that much. There's $8 trillion of money market funds, and that didn't eat into any deposits.
But we're in a different interest rate environment, right? So I do think that changes, right? And the banks are actively worried about it, and they're telling people they're worried about it, right? And if they're raising the flag,
we've been complaining about money market funds for years too, and it didn't end up being a big deal.
But money, the money outstanding just continues to grow, right? So I think that masks part of that, right? But look at what Stripe is doing. Stripe is saying, okay, we're going to have virtual accounts for SMBs, U.S. and global, and we're going to have them in stablecoins, and then we're going to offer you the full stack to issue or to move stablecoins between each other.
Yes, that's
right?
different than a money market.
Yeah, and that is there actively replaces a deposit for an SMB. That, by the way, they hate the banks because the banks do not serve SMBs well, right? And so the biggest problem these startups have across my portfolio and across many others is actually getting good bank accounts and getting good banking, right? And so I think it's not going to replace deposits. It is going to eat into deposits, and it is going to require that the banks digitize and that they compete and that they come into the 21st century.
And well, I will remake the point that I made before. That is true for the United States. Everywhere else is different. 35% of USDT users in this moment use USDT as a savings account. And definitely we see and we think that local currency deposits in all the emerging market jurisdictions will be affected eventually by the usage of stablecoins, just because there is an incentive to hold dollars, and the best way to hold dollars in non-US jurisdictions is to have stablecoins, and people are waking up to it, and so the growing market cap of USDT proves that.
Mm-hmm. Before we wrap things up, Paolo, you confirmed last week that Tether was raising a lot of capital, between $15 to $20 billion, I believe, at a $500 billion valuation. You said it's to maximize the scale, but I would love to know two things. One, why are you raising funds when the business is extremely profitable? And then two, people are speculating on an IPO. Are we going to get one?
So, definitely not in the short term.
Yeah.
But I know the valuation of 500 billion is a bit cheap, but we should...
It should have been $1 trillion.
Yeah, I know.
Yeah.
I know.
They don't write checks
when
that
you
big.
deal with bankers, it's like they're trying to... Jokes aside, I think that we are seeing... So Tether, we are very lucky because Tether is very profitable. Last year we made 13.7 billion in profits. This year, I think we are going to top that. But we are expanding different areas from peer-to-peer local artificial intelligence to telecommunication to social media. Look at Rumble, for example, energy. And we are building, I believe Tether will be able to build decentralized electricity for Africa by 2030, 2031. So our aim, in Africa already what we're doing, for example, is this group of kiosks. So we go in villages and we create a kiosk with solar panels on top, and we put 300 rechargeable batteries inside, and we sell subscriptions for $3 3 USDT per month to swap the batteries 4 times per month. There are 600 million people in Africa that don't have access to electricity, but they have small equipment like radios, small TVs, or smartphones. The average cost of a smartphone in the poorest part of Africa is between $60 and $90. And so we believe that right now we built 500 kiosks. We have 500,000 users of these batteries already in Africa. We think that we can scale up to 150,000 kiosks by end 2030. That would be a massive economy around USDT and the dollar that is very, very much of interest in that region, because they don't want, these communities don't want to hold to their local currency. But on top of that, we are going to create this peer-to-peer decentralized electricity system, and it's one change that you can see from space, because right now if you look at the center of Africa during night, it's very, very dark, and so with the decentralized electricity, we think we can actually light up also Central Africa during the night, creating this massive economy, again, a peer-to-peer economy through all these villages, through our kiosks, and that will be one of our massive interests and focuses in the next few years. And this is one of the 120 companies that are invested in the last 5 years. Imagine the others.
Yeah. Okay. So expansion beyond stablecoins into a completely different sector.
Yes.
All right. And then Charles, what about you? Paxos. You guys raising a massive fund and/or IPOing? And is Dragonfly investing?
We'll raise money at $500 billion too. I don't think we're going to. IPO is not in the cards for us right now, but you always want to look at the markets. They're obviously very embracing of crypto companies. I think that's something that makes sense, and eventually, when you're an infrastructure business, it always helps to be a public company. But I don't think that's the right thing for us now. We got to put our heads down and just take advantage of this market opportunity to keep building.
Yeah, for sure. Amazing. Well, Paolo, Charles, Rob, thank you so much for taking the time, and thank you to everyone for listening in.